If you had invested $10,000 in the US stock market several decades ago, what would it be worth today? The answer isn't just a number. It's one of the biggest reasons millions of Americans continue investing through recessions, market crashes, and economic uncertainty. History tells an interesting story. Every decade has brought a new reason to fear the market. Wars, inflation, financial crises, and global pandemics have all convinced people that investing was simply too risky. Yet despite all of those challenges, the stock market has continued to play a major role in creating long-term wealth for many patient investors. So, how is that possible? To understand the answer, we need to go back to where investing really began. Why the stock market exists. More than 200 years ago, building a successful business wasn't just difficult, it was expensive. Imagine trying to build a railroad, a factory, or a shipping company. Few people had enough money to fund projects on that scale alone. So businesses came up with a different idea. Instead of finding one wealthy investor, they divided ownership into thousands of small pieces called shares. People could buy those shares, helping businesses raise money to grow. In return, investors became partial owners. If the company succeeded, they had the opportunity to benefit from its growth. That simple idea transformed the economy. For the first time, ordinary people didn't need to own an entire business to participate in its success. They only needed to own a small piece of one. What does investing really mean? Many beginners think investing means finding the next company that will make them rich. But that's not what successful investing has historically been about. When you buy a stock, you're buying a small ownership stake in a real business. You're investing in the company's future, its products, its employees, its customers, and its ability to grow over time. Some businesses succeed, others don't. That's why investing always involves risk. The goal isn't to predict tomorrow's winner. It's to own businesses that can create value over many years. The power of long-term thinking. One of the biggest mistakes beginners make is focusing on what the market will do tomorrow. Professional investors know that's almost impossible to predict consistently. Instead, many focus on a much bigger picture. Think about some of America's most successful companies. They didn't become industry leaders overnight. They spent years developing products, expanding their businesses, and adapting to change. The stock market reflects that same long-term journey. Prices may change every day, but real business growth often takes years. That's why experienced investors often spend less time reacting to daily headlines and more time thinking about the future. Of course, staying calm is easy when markets are rising. The real challenge begins when fear takes over. And over the last 4 decades, investors have faced some of the most frightening moments in financial history. The question is, what happened to the people who stayed invested? Let's start with one of the darkest days Wall Street has ever seen. October 19th, 1987. Black Monday. In a single day, the U.S. stock market fell more than 22%. Investors panicked, and many believed the financial system was in serious trouble. But the market eventually recovered and continued growing over the years that followed. Then came 2000. Technology stocks had captured the world's attention. Many investors believed internet companies could only go higher. They were wrong. The dot-com bubble burst, wiping out hundreds of companies and billions of dollars in market value. Next came 2008. Banks collapsed, millions lost their jobs, and markets around the world plunged. Once again, many people gave up on investing. Then, in 2020, COVID-19 brought the global economy to a sudden stop. Markets dropped rapidly as fear spread everywhere. Yet history repeated itself. Markets eventually recovered. Each crisis had a different cause, but they all taught the same lesson. No one knows what the market will do next week, next month, or even next year. But history has repeatedly shown that fear is temporary, while long-term investing is about patience. So, how should a beginner start? If history has taught us anything, it's that investing without a plan is difficult. So here's a simple roadmap. Step 1. Build an emergency fund before you invest. Having cash set aside means you're less likely to sell investments during unexpected emergencies. Step 2. Decide why you're investing. Retirement, financial independence, buying a home. Your goal will shape your investment strategy. Step 3. Open a brokerage account. This is where you'll buy and hold investments. If available, retirement accounts such as a 401k or Roth IRA can also provide valuable tax advantages. Step 4. Don't try to find the next superstar stock. Many beginners choose diversified index funds or ETFs, which spread your investment across many companies instead of relying on just one. This reduces the impact if a single company performs poorly. The habit that matters. One of the biggest myths in investing is that you need a large amount of money to begin. In reality, consistency has often mattered more than the size of your first investment. Many investors use a strategy called dollar cost averaging. Instead of trying to predict the perfect time to invest, they invest a fixed amount regularly, every week or every month. When prices are high, they buy fewer shares. When prices are low, they buy more. Over time, this approach removes much of the emotion from investing and helps build discipline. By now, you know how to begin. But one question remains. Can these simple habits really lead to significant wealth over time? To answer that, we need to understand the one force that has shaped more long-term investment success than almost anything else: time. How time can turn small investments into long-term wealth. The real secret: compounding. Imagine planting a single tree. In its first few years, it grows slowly. You may not notice much change. But as the years pass, the tree becomes stronger, larger, and produces more branches. Investing works in a similar way. In the beginning, progress can feel slow. But over time, your investment has the potential to grow, and any returns may also begin generating returns of their own. This is known as compound growth, and it's one of the biggest reasons many investors start as early as they can. The goal isn't to double your money overnight. The goal is to give your investments enough time to grow. Can you really build a $1 million portfolio? $1 million sounds like an impossible number. But for many long-term investors, it wasn't built with one lucky investment. It was built through years of consistency, investing regularly, reinvesting earnings, staying diversified, and continuing through both good markets and bad. There is no guaranteed path to $1 million portfolio, and every investor's results are different. But history shows that disciplined investing over long periods has helped many people build substantial wealth. The journey usually isn't exciting. It's often slow, and that's exactly why many people quit too soon. Mistakes to avoid. Before we finish, here are 5 mistakes that many beginners make. First, waiting for the perfect time to invest. The perfect time is usually only obvious in hindsight. Second, putting all your money into one company. Diversification can help reduce risk. Third, reacting emotionally to market headlines. Fear and excitement have influenced investors in every generation. Fourth, expecting quick results. Investing is a long-term process, not a shortcut to overnight wealth. Finally, giving up after a market decline. History has shown that markets experience ups and downs, and patience has often been an important part of long-term investing. The stock market has survived world wars, recessions, inflation, financial crises, and a global pandemic. Every generation believed it was facing a challenge unlike any before. Yet businesses continued to innovate. New industries emerged, the economy changed, and long-term investors adapted with it. Perhaps that's the most important lesson of all. Successful investing isn't about predicting the future. It's about preparing for it. So whether you're investing your first $100 or building a portfolio over the years ahead, remember this. Every experienced investor once made a first investment. Every large portfolio started small, and every long-term journey began with a single decision. Thank you for watching. If you enjoyed this documentary, consider subscribing for more videos on investing, personal finance, and building long-term wealth.